Welcome to Nichols Tax Update Podcast, issue 21-38. Here's the standard disclaimer. Please read it. But I do want to emphasize the third paragraph. I acknowledge the value in preparation of this program of my subscription to Tax Notes Today. It is a tax update service published by tax analysts. In my view, tax analysts is the preeminent source of information for tax professionals, and Tax Notes Today should be daily reading if you want to stay on top of the changes in the tax law to benefit your clients and your practice. What's in this week's edition? 7 items. The court determines that the amount paid for psychotherapy is for medical care, but the taxpayer doesn't get to just estimate an amount. And then the Ninth Circuit says that tax advice is not privileged. I sure want to talk about that because I thought that we had Code Section 7525, which says that it was. And then an IRS executive in a webinar has said that partnership audits are about to get real. I didn't know that they never were real, but apparently the folks at the IRS believe that they're going to get tougher, and they're going to tell us why and what tools they plan to use. A historic package of tax code changes has been introduced. Every 2 or 3 years, we get a historic package of tax code changes. Your tax team is working on CPE for the new tax law. As soon as it passes, we'll have the training ready within a week after the president signs the bill. But we can't have CPE on the new tax law until the president has signed it and Congress has signed off on it. The Fifth Circuit, in a decision settling a 20-year-long dispute between husband and wife, affirms a deficiency but not a penalty. And I thought that was very odd. And we'll talk about why I think it's odd. And then an audit technique guide has been revised on not-for-profit activities. That's Section 183, hobby losses. I want to go into the 2 lists that are in that audit technique guide that I think will prepare you to deal with your client on activities that the client wants to claim losses that may or may not be at risk under Section 183. And then finally, 2 practice units issued by the IRS last week. One on foreign currency transactions, the conversion of foreign currency to US dollars, and the second one on the capitalization of self-constructed assets. A little late, maybe, but authoritative and useful. Psychotherapy is medical care. That's what the court said. Now, the taxpayer said psychotherapy was medical care too, but her estimate was a little high. Rebecca Tressler got $82,500 in settlement of her claims for hostile work environment against Amtrak. $27,500 was subject to withholding as payment for back wages. The remaining $55,000 was for alleged claims for physical injuries, emotional distress, attorney's fees, and costs. Ms. Tressler estimated that 1/2 of that amount was not taxable because it was a payment for physical injury. The court said, no, bring us your receipts. What did you pay for treatment for your physical injuries? That's the amount you can exclude. That's only $6,980, not half of $55,000. Psychotherapy is medical care, but you can only exclude from one of these settlements the amount you actually pay for the psychotherapy. The Ninth Circuit says tax advice is not privileged. Really? I thought it was. Let's look at the details. This case is cited as in regard to grand jury. A law firm and its client are held in contempt of court for failing to comply with grand jury subpoenas to hand over dual-purpose communications. Dual-purpose communications had legal advice and tax advice, or legal advice and business advice. In any event, I want to tell you up front, dual-purpose communications cannot be protected under any doctrine of privilege. That's where this got screwed up. The Ninth Circuit says the primary purpose test applies here to determine whether attorney-client privilege applies. And since this was legal advice and tax advice, the primary purpose was to obtain tax advice, not legal advice, and the court refused to acknowledge that the application, we might apply Section 7525. I don't know why. I've got this note here. Wait. What about Section 7525? I thought that CPAs could claim a confidentiality privilege relating to taxpayer communications, but I also know that if we're going to claim confidentiality privilege for tax advice, it can only be tax advice. It cannot be anything else. So dual purpose communications, transmitting tax advice and something else, will not enjoy the privilege of Section 7525. That's what I wanted to call to your attention. I think this decision here is a one-off. I'm not too concerned about it as it would relate to us giving tax advice, but it's a good reminder not to produce dual purpose communications. If the client wants some tax advice and some business advice, write two separate letters. Section 7525 does not protect dual purpose communication. Partnership audits are coming to an office near you, and they are about to get real. I thought that was an interesting choice of words in a webinar coming from the mouth of an IRS executive. The IRS will begin to implement its large partnership compliance program audits within a few weeks, and they're going to use new data analytics methods. They're going to apply artificial intelligence to identify both subchapter K risks, that's statutory risks, and operational risks when the audits start at the beginning of this new fiscal year. These are audit techniques we have never seen before. These risk assessment techniques, which they're obligated to perform before the audit begins, will be augmented by expanded transaction reporting, and they're expected to produce significant revenue improvement. This is the same that we are doing on the attest part of our practice. We are employing risk assessment techniques. We're applying AI, artificial intelligence. We're applying data analytics to improve our methods for addressing our opinion, developing an opinion on the financial statements of the client as it results from the transactions that we audited. At least that's what my audit brethren over on the other side of the firm tell me. So the IRS is going to be doing the same things with their tax audits that we are doing with our financial audits. And they're going to be using the same kinds of tools. Tax changes. Here we go again. Red light, green light, red light, green light. Defer income, accrue income, claim the credit, take the deduction. Corporate tax rates are going to increase. Graduated rates return. The top individual tax rate will increase. No more rollover from traditional to Roth IRA. Limit on accumulations in IRAs. If you have taxable income of $400,000 or more. Mandatory distributions when the IRA balance gets to be too big. The capital gain tax rate is going to increase for the wealthy taxpayer. There's going to be an employer mandate forcing contributions to retirement plans, and you're going to be able to join the tax team for CPE, first presentation of team tax. We're going to talk about this a little bit in the first presentation of team tax on December 2nd. Watch the communications you're getting from SCAPA. That team tax is going to cover current developments. Some of those current developments are going to be what we know about the new tax law, but essentially what you need to know to provide tax guidance in 2021 and planning for 2022. Special coverage on the PPP loan forgiveness, special coverage on the employee retention tax credit, special coverage on IRAs and other retirement accounts. I think it's going to be a very interesting program. The new tax law will not be all the program, it'll be a piece of the program. That's December 2nd. And if you missed that one, there's another one on January the 6th. Anyway, just a little plug for coming attractions. Here's a man having trouble with his ex-wife. The trouble comes from the fact that they tried to continue to do business together. Lawsuits, 4 different lawsuits arose out of their attempts to do business and invest money together. And they had a very contentious, toxic relationship. He alleges that she owes him over $1 million when you factor in all the expenses and fees. The case is cited as Ames Ray. The decision coming out of the Fifth Circuit. These are deductions he claimed on his 2014 federal income tax return for legal expenses. Now, legal expenses incurred in connection with activities conducted for a trade or business. We know trade or business expenses are deductible. But Mr. Ray and his wife were not engaged in a trade or business. This litigation, as I said, has been up and back for 20 years. The focus of this ruling, however, is on the origin of the claim doctrine. So in my view, we have a teaching case. What is the origin of the claim doctrine? Well, in this case, Ray was not entitled to deduct his legal expenses under Code Section 162A, trade or business expenses, because he and his wife were not engaged in a trade or business. But the tax court was wrong when it found that he couldn't deduct his legal expenses incurred to recover his ex-wife's indebtedness as expenses for the production of income under Section 212. So you have to look at the origin of the claim, the nature of the claim. Mr. Ray was not suing. His legal expenses were not incurred in connection with a trade or business. They were incurred in connection with an activity for the production of income, and that's the difference between Section 162 and Section 212. The origin of the claim test applies to determine the deductibility of legal expenses in this case, but it can apply to determine the deductibility of all kinds of costs and expenses in a variety of situations, and we as super tax consultants should be trained to look at the origin of the claim. Why does the taxpayer believe they can deduct this or that or the other? Why does the taxpayer believe they can claim storage costs? Why does the taxpayer believe they can claim legal fees? Why does the taxpayer believe they can claim expenses paid for a stenographer? Why does the taxpayer believe they can claim expenses for travel? Is it a trade or business activity or an activity for the production of income? Origin of the claim. It's an important doctrine for the tax professional to understand. An audit guide on Code Section 183, not-for-profit activity, has been revised. It's really helpful, I think. All kinds of hobby losses. You're taking courses to educate yourself. Is it in connection with your trade or business, the production of income, or are you just studying Mesopotamian history because you want to know? Are you learning to tie flies or play the guitar or play bocce ball? Are you developing sports statistics? Are you going to be a professional photographer? Are you painting and going to sell the paintings? All of these things could be income-producing activities. They can also be hobbies. And if it's a hobby, losses incurred in connection with a hobby are not deductible. Internal Revenue Code Section 183 says so. And IRS auditors love to audit hobby losses. Publication 5558 even tells them how. And it's revised heavily in September of 2021 to emphasize the 9 factors that the agent is to examine. Was the activity conducted in a business-like manner? What's the expertise of the taxpayer or advisors? Taxpayers' time and effort, the amount of occasional profits, etc., etc., everything on that list. And if you have audited the 9 factors, then there are 10 tips for you, the examiner, to do a good job of writing up your report so that the appellate conferee or the tax court judge or the IRS counsel who gets this case on appeal will understand exactly what you did, and in fact your work may result in a win for the IRS. Finally, there's a practice unit on foreign currency transactions. All these coins. If a business is doing transaction business, if an entity is transacting business in different currencies, you're doing business in Canada, the United States, Mexico, and in England, you're going to have business in pounds and Canadian dollars and pesos. In order to properly report your U.S. taxable income, you have to convert dollars into U.S. currency, into dollars. This practice unit tells the IRS auditor what principles should be employed by the taxpayer to honestly convert foreign currency into dollars, what the timing should be, how to convert foreign currency into dollars for the reporting of U.S. taxable income. It's that simple, and yet it's still that complex. I said, finally, I was mistaken. Our last item this week is a practice unit on capitalizing self-constructed asset. This tells us how to employ Section 263 capital A, or how to observe those limits for capitalizing self-constructed assets. Actually, it tells the IRS auditor how to audit, but it tells us how to do it right. It provides guidance for capitalization of self-constructed assets, what costs are to be capitalized under 263 Cap A, 3 categories: Section 471 costs, additional Section 263A costs, and interest costs. Now, for purposes of Code Section 263A, self-constructed assets, that term, Section 471 costs, includes costs other than interest capitalized to self-constructed assets in financial statements. Consider this actual quote. Section 471 costs should not be confused with Internal Revenue Code Section 471 costs, which applies only to inventories. Seriously? Who wrote that crap? Some Section 471 costs are applicable to construction in progress, and those should be capitalized under 263 Cap A. Other Section 471 costs are applicable to the production of inventory, and they are not capitalized under 263A. Refer to the Interest Capitalization for Self-Constructed Assets Practice Unit for guidance on the capitalization of interest to self-constructed assets. I'm sorry if I got a little irreverent there. I wasn't profane, just irreverent. There's a difference. Although sometimes the difference is a little fine. Thanks for joining me every week. Oh yeah, there's more. 263 Cap A, remember, is a timing provision. It doesn't create or disallow deductions, it just changes the timing, and a small business taxpayer is exempt from the uniform capitalization rules until they have, for 2021, more than 26 million in average annual gross receipts for 3 consecutive years. And by the way, this practice unit addresses the taxpayer on the accrual basis of accounting. That is it. I know that's it. We're done. Thank you for your participation and your support. Stay with me. We're going to get through this together, and make a space in your calendar to attend Team Tax on December 2nd.